Taxes are an important consideration when it comes to doing any kind of financial planning. They're not the only consideration, especially when it comes to investments. However, taxes will have an impact on the decisions that you make. And it's important to remember, and we'll keep emphasizing this, the way that our tax laws are structured. If you are trying to save taxes legally, that is called tax avoidance, and that is indeed legal. When you are not following the tax law, if you are essentially cheating, that is considered tax evasion, and that's where you're not paying the proper amount of tax, and that is illegal, and that will send you to prison if you are not careful. So, and ignorance of the law is not a defense when it comes to this. So uh, try to keep, at least have a working knowledge of the tax laws. The more complicated your issues are, uh, the more necessary it might be for you to bring in a professional. And we'll talk about professionals, professional tax people in a little bit. So for now, why don't we just jump into this? And I'm going to, again, try to do this on somewhat of a high level and have you do the reading of the other material. But uh, let me kind of put things into perspective for you. So, and I'm going to be jumping around here with regard to the PowerPoints. Taxes have been around for thousands of years to fund the government and government services. In fact, a major reason for the American Revolution was the imposition of taxes without the colonies having a representative for themselves in the British Parliament. So the method of taxation over the years, and I'm speaking primarily of the United States, it has varied taxation. So there may have been and some of these are still in effect. There may have been what they call a duty on imported goods. So an excise tax that is passed on to the consumer. So you as a consumer, you buy goods that the merchant has had to pay a tax on. So the merchant pays the tax, but basically passes that cost on to you in the form of a higher price. That is a duty, or otherwise known as an excise tax. So you don't even realize that you're paying a tax on it. It's a tax that was passed on by the manufacturer. There may be certain types of personal property like real estate. Those continue to this day, and real estate is often used to finance things like water and sewer and schools. Those are three very important things when it comes to taxing real estate. The current system of income taxation, now we're talking, pay income, or if you have commissions for your job, or if you have your own business and your business has a profit, those are all part of personal income taxation. And that started in 1913. The system that we have right now, although the first actual income tax was imposed during the Civil War around 1861, and that lasted about 10 years. There is also an income tax on capital gains. So that's when you make a profit on the sale of an asset, typically a financial asset. Now, the tax on capital gains will vary depending on how long you have held them. We'll talk about that. Excise taxes tax businesses on certain goods. So the cost of the tax is added to the price that you as the consumer pay. So we did mention that previously. There's also something, you don't hear about it as much, but there's something called an alternative minimum tax. So let's say, for example, you have all these tax loopholes that you are taking advantage of. And but let's say there are too many loopholes. So basically, when you're in a position like that, you have to file basically like two sets of income tax forms. And whatever is the higher one of the two, that's the one that you have to pay. And that's the alternative minimum tax. Typically, again, it's for people in higher tax brackets who make a lot of deductions of a certain type, deductions to reduce their income. So some of these terms may not be familiar to you yet. So hopefully let's go in and talk about them in more detail. Just to sort of give you a little idea historically, what you're looking at here is a listing of personal property taxes that were paid in a section of Center City, Philadelphia, near Front and Walnut Streets. I got this out of the city archives. This is from 1781. And this was a personal property tax. So there was somebody who would go around the neighborhood and they would look at what things that you had, whether it was a business or if it was certain items that were taxable. Sadly, even there's a listing here, one slave. There was a taxation on people who were enslaved. So those individuals were taxed to the owner, and as well as the type of occupation that that person had, that was also taxed. So there were any number of ways that the operation of government was funded, and this is certainly one way of doing that. And that also included a house, and if you had your own business, whatever merchandise was in that business that was held in that property that you had, that was also taxed. So that just gives you a little idea of what that looked like years ago. So I don't usually go over these right now, but I think it might help to kind of give you a little jump start on understanding taxation. So these are facts or fantasies, what's true and what's not true. Every individual or married couple is required to file a federal income tax return, regardless of the amount of income earned. Well, that's false. Depending on your income, depending on if all of the information is reported to the IRS, not everybody is required to file a federal income tax form. Now, if you want to get money back, if you have overpaid, then you do have to file a federal income tax form. The amount of federal income tax withheld, okay, depends on both your level of earnings and the number of withholding allowances claimed. That is true. So when you start out the beginning of the year, you don't really know how much income you're going to wind up at the end of the year. You could change jobs, you might get a promotion, you might get a demotion, and maybe your income goes down. So when you are having your income tax taken out of your pay, you can have more or less taken out. You don't want to have too much taken out because it's almost like a loan to the federal government that you don't get any benefit from. At the same time, you don't want to have too little taken out, because if you don't have enough money taken out of your pay to cover your taxes, then you're going to wind up paying a penalty. So, so understand there's a two-part process here. You tell them how much you want to have taken out, and then you have to actually do a tax return at the end of the year, usually by about the 15th of April of the following year. So you file that return to determine how much you actually owe. And then if you have paid in more than you owe, then you get a tax refund. If you don't have enough money withheld from your pay, then you have to pay the difference. And if the difference is too large, then you have to pay a penalty. Federal income taxes, or this is number 3, federal income taxes are levied against the total amount of income earned. Well, that's false. There are things like exemptions and deductions, credits. All these type of things are going to be make adjustments to your income, which will then ultimately determine how much you have to pay. So it's not the total amount of income that you are taxed on, but it's usually an amount after these deductions or exemptions or credits are taken into account. Number 4, all gains on the sale of investments such as stocks, bonds, and real estate are taxed at the lower capital gains tax rate. Well, that's not true. If you hold a investment like stock or bond and real estate, and you make a profit on it, and you have held it for a year or longer, you then are able to pay that tax on that gain at a lower tax rate than it would be for your ordinary income. So if your salary income is, say, 25%, but you've held an investment for longer than a year, you're going to pay the gain tax, the capital gain tax, at a lower rate than your 25% income tax, probably somewhere in the 10 or 15% range that you'll pay. Next, number 5, tax credits, deductions, and exemptions reduce your taxable income by comparable amounts. Well, this is also false. There's a difference between a deduction and an exemption and a tax credit. A tax credit is money dollar for dollar that is basically covering you for which you would normally pay tax. So if you get a tax credit of, say, $100 and you owed $200 in tax, that $100 of tax credit will offset the $200 that you owe, and you only owe $100. That's a tax credit. It's a dollar for dollar offset of with a credit versus your tax paid. A deduction, on the other hand, is something that is deducted from your income, so that instead of paying tax on, say, $50,000, if you have a $2,000 deduction from the $50,000, you're only going to pay tax on $48,000. Exemption is something that is also a reduction of your income, but it's done for a different reason. It might be, for example, your tax status. If you're married, filing jointly, or if you're single, there's usually like a one-shot exemption that is used to reduce your taxable income. That's unlike a deduction, which that's going to come into play depending on what type of expenses that you incurred during the year. An exemption is based on what your status is: single, married, head of household, that type of thing. Okay. Next, an easy way to earn tax-deferred income is to invest in Series EE savings bonds. That is true. You buy a EE savings bond, and you only pay the tax when you cash it in. Now, you can pay tax along the way if you wish, but it can get to be a nightmare after a while. So what most people do is they will buy these savings bonds, and the interest will just continue to grow until you cash it in. Now, if you're using these EE bonds to help pay for college, then what you need to do is to see what the laws are for that. It's possible that that income that you earn on that savings EE bond can be tax-free if it's used for the going toward your tuition. These laws change on a regular basis, and it depends on how the bond is titled, whose name is on the bond, in other words. That'll determine if you can get the income at tax-free. So moving right along then. So the typical American family pays about 1/3 of its gross income in taxes. So that's federal income tax, Social Security tax, and Medicare tax. There you also pay taxes to the state, you also pay property taxes, and you also pay sales taxes. So again, your goal is to legally minimize taxes. Tax avoidance is legal, tax evasion is illegal. Tax evasion is where you are hiding income, income that you're supposed to be taxed on. Okay, or you're taking deductions that you're not permitted to take or that never really occurred. Any way that you are not paying your tax legally is called tax evasion. Tax avoidance, however, if you're doing it all legally, that is doing it all properly, then it's all legal and you're fine with that. A lot of times the way that the Congress will write the tax laws is they want to give an incentive to people for various reasons. So for example, mortgage interest may be deductible for you. They want to encourage people to own homes. So by having a mortgage interest deduction, that gives people the incentive to want to buy a house. An additional benefit of people buying a house is they need to make improvements. So when you have improvements, then there's going to be additional products that have to be purchased, which will stimulate the economy. You may have a contractor who's going to work on your house that will also stimulate the economy because it's providing jobs for people, and so on and so forth. So there's a great benefit to the government to incentivize people to buy a home. And that's why they write the tax laws in such a way to benefit certain segments of the economy. So about half of total taxpayers pay no income tax at all, but everyone pays a Social Security or Medicare tax. We'll talk more about that in a bit, but the total tax for Social Security and Medicare is 7.65%. And it's on wages that is paid by the employee. That's Medicare. Everybody, that includes the employer and the employee, pay Social Security tax. Taxpayers with income over 250,000, which is about 2.4% of the tax returns that are filed, they pay almost half of all the income. So you may hear talk about the 1%, the people in the high tax brackets, I'm sorry, the people who earn the highest income, but understand that people who are, and those are people who are earning millions and millions of dollars a year, but understand that even people who are even just 250,000 or more, they're still paying close to all the income tax, half of the income tax that's throughout the United States. Okay, so how do you calculate taxes? Well, the tax is usually based on a tax rate times a tax base. So the name of the tax indicates what the tax base is. So for example, property tax has a value of property. There's a certain value of your property that is assessed. And then same thing with sales tax. A sales tax, the tax base is the sales price. So you go to the store and you want to buy an item in Pennsylvania, it could be 6% a sales tax that's over and above what you're paying for the item. In Philadelphia, they tack on 1 or 2 more percent. And so these are additional taxes that you pay when you buy something. Property taxes are based on the value of your property. So if you buy a home, every year you're going to have to pay property taxes that are somehow based on the value of your home. The actual calculation is going to vary from county to county and municipality to municipality. So I'm not going to go into the specifics right now, just that it will vary from place to place. You lower your tax by either lowering the tax rate or you have a lower tax base. So you pay less tax, for example, if you're buying a less expensive item when it comes to sales tax. If you're buying a piece of property, if the tax rate is lower in one area versus another, then you're going to wind up paying a lower tax. Also, again, depending on the value of the property. So the lower tax rate is based on the nature of the income. So capital gains and dividends might be taxed at a maximum of 20%. Whereas personal income taxes on your income could be as high as 39% or more. So when it comes to selling a home, there are certain amounts that you are exempt from paying tax on. So if you're single and you sell a home, if you make $250,000 on the gain and you walk away from that property, you can save taxes on $250,000. If if the property is in both names, you and say a spouse, then the amount is 500,000, twice the 250,000. So again, if you have a property, a house you're living in, and you sell it for a gain of let's say 250,000, if you're single, then you do not have to pay capital gains tax on that property. Okay. If you're married and you file a joint tax return, if the gain is up to 500,000, you don't have to pay tax on up to $500,000 of the gain. Finally, you lower your tax base with deductions, exclusions, and exemptions. We talked about that previously. So let's say you're a single taxpayer. All right. Now these are based on the tax laws for a few years ago. But the thing about the taxes, the way that we have them in our country, is that we have progressive taxes. So the higher your income, the higher your tax bracket, the higher the income the higher the percentage of taxes that you pay. But let me explain how this works. And the best thing to do is to show you using the tax rate for 2018. Now, let me just check something here. All right, this is the next tax. So, all right, so let's look at 2018. So here's the way it works. Let's say that I wish that I earned $500,000 for the year. So, or let's say it's $501,000, 501. So you see this chart and it says 37%. Okay, now this doesn't mean that you pay 37% of 501,000. This is your marginal rate. This is every amount that you earn over 500,000 is taxed at 37%. So here's how this works. So I earn $501,000 for the year. So it's broken out as follows, using the tax rates for 2018. It's going to be different for the year that you're watching this video. So for the first, in this example, $9,525, I'm going to pay 10% on that amount of money. So remember, I've earned 501,000, but the first 95.25 is going to be taxed at 10%. And then the amount between 95.26 and 38.7 is taxed at 12%. The amount that is between 38.701 and 92.5 is taxed at 22%. The amount that's between 82.501 and 157.5 is taxed at 24%, and so on and so forth. So really, if I'm earning $501,000 of income, my entire amount is not taxed at 37%. The amounts that I just showed you, as you're building up to the 501, these are the tax rates as you move higher and higher up the income scale, so that finally anything that is earned over $500,000 is taxed at 37%. This is how our progressive income tax system is done. Now, a change in interest in tax rates, you can see here, for example, the highest tax rate in 2017 was 39.6, and in 2018 it was 37. So that can make a big difference over time. So when your income, let's say in this example, was 36,900, Okay, so that puts you in this category here in the second bar down. All right, so for an individual, when you do the calculation, in 2017, that person paid $5,068.75 in federal income taxes. But because the tax rates were lowered for a certain income bracket, they only have to pay $42.37.50. So that's a savings there of, what is that? Almost, it's over $800. Yeah, $831. So tax changes, tax law changes, tax rate changes can make a big difference. That's more money in your pocket compared to the money in Uncle Sam's pocket. Okay. So I mentioned previously, we have a progressive sales tax. The more income you make, the higher the tax rate that you pay. A sales tax, on the other hand, is a flat rate typically. So it could be 8%. In other parts of Pennsylvania, for example, it might be 6%. Now, a sales tax is flat, but it's considered as a regressive tax, meaning that the lower your income, the higher the tax you pay. Let me explain. When you earn a lot of money, the more money you earn, typically your propensity to consume, in other words, the money that you spend for your daily living, on a percentage basis, it goes down the more money you make. So if I make $50,000 a year, most of that money is going to be used to maintain my house, my car, food, things of that nature. And maybe I'll have a small amount left over for investing or saving. On the other hand, if I'm earning $500,000, that's going to be a much higher percentage of saving, because I don't need to spend as much money on my property or my food or things of that nature. So that's why a flat tax hurts people in lower incomes more than it hurts people in higher incomes. Progressive taxes hurt people in higher incomes, and they're better for people in lower incomes. So a lot to think about here, okay? Remember, an income tax is you're taxing your income. A sales tax is where you're taxing your sales, what you're buying, what's being sold to you. A property tax is where your property is actually being sold to you. Okay, and the property that you're buying. Okay, so I'm going to just go over this right now, and then we're going to stop for part 2. So tax rates are identified in a couple different ways. So if you take the total amount of tax that you are paying divided by your taxable income, that gives you your average tax rate. So remember, when we were looking at these tax rates here in 2018, different segments of your income were taxed at certain amounts. So if you figured out the total amount of actual tax that you're going to pay and divide it into your taxable income, that's going to be your average tax rate. Okay, because not all of your income is taxed the same way. On the other hand, the marginal tax rate is the tax rate on the next dollar of income that you earn over and above what you currently are earning. So, as in this example here, anything over $500,000 was taxed at 37%. So at $501,000 of income, $1 is going to be taxed at 37%. The amount between $200,000, $1 and $500,000 is taxed at 35%. Okay, so this is the difference between a average tax rate and a marginal tax rate. And with that, I'm going to stop for now, and then we're going to move on to the next segment on taxes.